Welcome to MacroTech Online Educational Services. We are going to start a revision series for upcoming UPSC Civil Services Examination Prelims 2025. Today is day number 1 and we will understand some basics of Union Budget 25-26. I am going to cover Union Budget 25-26 in 3 to 4 parts. Today is part number 1. Let's start. According to Article 112 of the Indian Constitution, the Union Budget of a year, also referred as the annual financial statement, is a statement of estimated receipts and expenditure of government for that particular year. Union Budget keeps the account of government's finances for the fiscal year that runs from 1st of April to 31st March. Union Budget is classified into Revenue Budget and Capital Budget. Let's understand what is Revenue Budget and Capital Budget. Revenue Budget deals with day-to-day operational expenses and recurring income of government. It includes revenue receipts and revenue expenditure. Revenue receipts consist of tax revenue, non-tax revenue, grants, and interest earned. Revenue expenditure includes salaries, subsidies, pension, maintenance cost. For example, salary of government employees, subsidies on essential commodities, welfare schemes, healthcare expenses. Now, what is capital budget? Capital budget deals with capital expenditure and investment made by government. Focuses on long-term infrastructure development and asset creation. Please remember, this is very important, asset creation. It includes expenditure on acquiring or creating assets like building, roads, bridges, machinery. It aims to enhance the productive capacity of economy and improve public services. For example, construction of highways, airports, dams, investment in education, and healthcare expenditure. Let's dive into details. First one, revenue budget, classified in two parts, revenue receipts and revenue expenditure. In revenue receipts, these are the receipts that don't directly impact the asset or liability of Government of India. Please remember this point. It doesn't create any asset or liability. Revenue receipts primarily consist of tax revenue and non-tax revenue. In case of tax revenue, you can see here money earned through various taxes imposed by government such as excise duty, income tax, GST, customs, and in non-tax revenue, income generated through sources like dividends from public sector undertakings, interest, receipts, profits from government enterprises, fees, fines. Now, second part, revenue expenditure. This refers to day-to-day operational expenses incurred by government. The component of revenue expenditure in India include salaries, pension, interest payments, subsidies, administrative expenses. Now, second, capital budget. It also divided into two parts, capital receipts and capital expenditure. First part, capital receipts is very important because it creates liability, or you can say decrease in assets. In India, capital receipts mainly include disinvestment and borrowing and loans. So what is disinvestment? Money earned by selling assets like shares of public enterprises, borrowing and loans, funds received through borrowings or repayments of loans by government or states. Second, capital expenditure. This refers to expenditure incurred by government that leads to creation of assets or reduced liability. So in case of capital expenditure, popularly known as capex, So it's increase assets or reduce liability. For example, investment in infrastructure, long-term investment made by government to create assets such as building, roads, bridges, hospitals, schools. Loans to state, funds provided by central government to states or repayment of its own borrowing. For prelims examination, it is very important to remember some examples. First part is receipt side. You can see here revenue receipts and capital receipts. Examples of revenue receipts under tax revenue and non-tax revenue. In case of tax revenue, further divided into two parts, direct tax and indirect tax. In case of direct tax, income tax, corporation tax, expenditure tax, wealth tax, state duty. And in case of indirect tax, you can see here sales tax, custom duty, excise duty and all. Now very important, non-tax revenue. Interest receipts, profits dividend, fees and fines, external grants, special assessment. Now second, capital receipts. Recovery of loans, disinvestment, borrowings, provident funds. It all come under the capital receipts. Now expenditure side, in case of revenue receipts, you can see here some example. Payment of interest, payment of salaries, pensions, grants and subsidies, education, health services, defense services. In case of capital expenditure, construction of roads, building, purchases of land machinery, investment in share, loans to state and foreign government, repayment of loans. For examination purpose, you should remember very important point, revenue expenditure which neither creates asset or reduces liability, and in case of capital expenditure which creates asset or reduce liabilities. Now what is deficit? When government's expenditure exceeds its revenue. Now types of deficit. First one, budget deficit. Total expenditure minus total revenue. Second, revenue deficit. Total revenue expenditure minus total revenue. Third one, very important, fiscal deficit. Total expenditure minus total revenue minus borrowing. So it indicates the borrowing of government. Fourth one, primary deficit. Fiscal deficit minus interest repayments. Because some previous year payments we will discuss in detail in original budget documents. And effective revenue deficit. Revenue deficit minus grants for capital assets. After basic understanding of revenue and capital budget, we will now read original document known as budget at glance.
Let's start with official document. Released by Budget Division, Ministry of Finance. Some points would be very beneficial for your prelims examination. First one, the list of budget documents presented to Parliament besides the Finance Minister's budget speech. First document, Annual Financial Statement under Article 112. Second, Demands for Grants. Third, Finance Bill. Fourth, Fiscal Policy Statements mandated under Fiscal Responsibility and Budget Act 2003. First, macroeconomic framework, and second, medium-term fiscal policy cum fiscal policies strategy statement. Next document, expenditure budget, receipt budget, expenditure profile, budget at glance, memorandum expanding the provision in finance bill, output outcome monitoring framework, key features of budget, and implementation of budget announcement 24-25. Now very important point, the documents shown at serial number ABC mandated by Article 112, 113 and 110 Clause A. Which document? ABC Annual Financial Statement. Then demand for grants under Article 113 and finance bill under Article 110, also known as money bill. Now first, annual financial statement. Annual financial statement as provided under Article 112 shows the estimate receipts and expenditure of Government of India for 25-26 along with estimates for 24-25 and also actuals of 23-24. It means estimates of 25-26, then revised estimate for 24-25 financial year and actuals for 23-24. The receipts and disbursements are shown under the three parts in which government accounts are kept: the Consolidated Fund of India, Contingent Fund of India, and the Public Account of India. In our upcoming lectures, we will discuss in detail what is Consolidated Fund of India, Contingency Fund, and Public Account. But for budget purpose and for economic point of view, you should remember some basic point that Consolidated Fund of India draws its existence from Article 266. So Article number 266 related to Consolidated Fund of India. All revenues received by government, loan raised by it, and also receipts from recoveries of loan granted by it together form the Consolidated Fund of India. All expenditure of government is incurred from Consolidated Fund of India and no amount can be drawn from the Consolidated Fund without due authorization from the Parliament. Parliament means Lok Sabha and Rajya Sabha, upper house, lower house. Article 267 of Constitution authorizes the existence of contingency fund. 266 Consolidated Fund and 267 contingency, which is placed at disposal of President of India to facilitate meeting of urgent unforeseen expenditure by government pending authorization from the Parliament. Parliamentary approval for such unforeseen expenditure is obtained ex post facto and an equivalent amount is drawn from Consolidated Fund to recoup the contingency fund after such ex post approval. Now after annual financial statement, second document, demand for grants under Article 113 of Constitution mandate that the estimates of expenditure from the Consolidated Fund of India included in annual financial statement and required to be voted by Lok Sabha be submitted in the form of demand for grants. The demand for grants are presented to the Lok Sabha along with annual financial statement. Generally, one demand for grant is presented in respect of each ministry or department. Now parents will, at the time of presentation of annual financial statement before the Parliament, A finance bill is also presented in fulfillment of requirement of Article 110 Clause 1 Subclause A of the Constitution, detailing the imposition, abolition, remission, alteration or regulation of taxes proposed in the budget. It also contains other provision relating to budget that could be classified as money bill. A finance bill is a money bill as defined in Article 110 of the Constitution. In very first part of this lecture, we will understand first document, budget at a glance. Budget at a glance presents broad aggregate of budget for easy understanding. This document shows receipts and expenditure as well as fiscal deficit, revenue deficit, effective revenue deficit and primary deficit of the government of India. We already saw in initial slides regarding what is FD, RD, ERD and PD. It gives an illustrative account of sources of receipts and expenditure through graphs and infographics we will discuss in upcoming lectures. For examination purpose, you should observe some trends. In revised estimate 24-25, the total expenditure is estimated 47 lakh 16,000 crore. Against this, total expenditure in actual for financial year 23-24 was 44 lakh crore. The total capital expenditure is estimated around 10 lakh crore in revised estimate as against 9 lakh 49,000 crore in the actuals. So please remember, in budget at glance document, first of all we should make one table to understand all data. Actuals of financial year 23-24, then revised estimate for 24-25 and estimates for 25-26 or this current financial year. For your better understanding, you can see here budget at glance. First one actuals, second budget estimate, then revised estimate and budget estimates for 25-26. So first, revenue receipts, tax revenue, non-tax revenue, capital receipts, recovery of loans, other receipts, borrowing, other liabilities. Total receipts consist of first and four. Revenue receipts and capital receipts equal to total receipts. We already discussed in our initial slides. Now this page is very important for you. Rupees comes from first one, the maximum portion from borrowing and other liabilities. Borrowing. Then second, income tax. Then corporate tax. Then fourth measure, GST. GST is a indirect tax. And some other indirect tax, union, excise, customs, non-tax receipts, non-debt capital receipts. But major portion, borrowing, income tax, corporate tax and GST. Now rupee goes to major portion, state shares and transfers. Second, interest payment on borrowings. Third one, finance commission other transfer, also equivalent to other expenditure, transfer in centrally sponsored scheme, central sector scheme around 16%. So first one, state shares. Second, interest repayment. Third one, central sector scheme. Fourth, centrally sponsored. So that's it for today. In upcoming lecture, we will see other documents and also complete first different kind of deficits in a great detail, which will be definitely very helpful for your upcoming examination.